U.S. commercial auto insurance line continues to burden the overall property and casualty industry, posting its 14th straight year of underwriting losses in 2024. Here to discuss the segment is David Blades, Associate Director, and Christopher Graham, Senior Industry Analyst, both in AM Best's industry research and analytics area. Chris and David, welcome. So great to see you both. Thank you so much for joining us.
Thank you for having us.
Great to see you, Lori.
Chris, another tough year for commercial auto, and in fact, losses are getting worse. Is that trend going hand in hand with social inflation?
It seems to be. We certainly have, we're certainly seeing the loss trend run far beyond what general inflation has been. And that's even when you consider that there's a cap on the losses from either, a net reinsurance standpoint or the policy limit. So you're really talking, and that there does seem to be inflation far beyond general economic inflation, which we attribute to social inflation. And we're also seeing claims taking much longer to settle, which only exacerbates the social inflation. Claims are open longer. There's more precedents that are comparable cases that that become relevant to whatever is open. So it does seem to be that social inflation is playing a big role here in these losses. And it's not just 14 straight years of underwriting losses. It's that they're getting to be really bad levels, where you're talking about $4, $5, $6 billion that the industry is losing the last couple of years.
Yeah, and on top of that, like you mentioned, the social inflation, you got third-party litigation funding and the impact that that's having on the liability aspect of commercial auto. So I think from that standpoint, from just social inflation and losses outpacing what we're seeing in terms of economic inflation, and then the fact that the industry is still dealing with how best to mitigate the impact of third-party litigation funding, I think that's also another factor that's contributing, unfortunately, to the continued losses that we're seeing in commercial auto.
Absolutely. Chris, the report notes divergent results in liability and physical damage. What are you seeing there?
This is where I think we're really seeing, to Dave's point, the impact of the third-party litigation funding. The liability losses are really where we're seeing the problematic results for the commercial auto insurers. There was about a 18 point gap in the first half of 2025, in addition to the gap that we saw in 2024. So it's actually getting to be even more divergent this year than what we saw through 2024. And where that can become problematic for the insurers, the liability insurance is compulsory. The insured still have to buy that no matter what. There's laws on that if you own a vehicle, you have to buy insurance. You have to buy the liability insurance. There's no such law on the physical damage part. There's room there for the insureds to possibly increase their deductible, which would hurt the insurer's profitability when you see these type of divergent results. It would set up that, if the liability losses are the problem and physical damage is the so-called savior right now, is still as bad as it is, well, it might not be there if the insured start increasing their deductibles. It's set up that, the results, the underwriting losses could be even greater as insured start seeing, might be seeing the benefit in higher deductibles or less physical damage coverage in general. So the divergence can really become a problem for the insurers now.
Absolutely, yes. David, the losses beg the question of why insurers stay in the market. What do you think's driving those decisions?
So it's funny. So I think about that from the perspective of when I was in the underwriting field, right? So from a commercial auto perspective, when you think of the businesses, commercial business concerns, you have commercial businesses that have service vehicles, whether it's landscapers or electricians, plumbers that are driving around in their vehicles. You also have the retail vehicles for furniture stores or food restaurants that are just delivering food out, delivering things. And then you just have the commercial vehicles that are just transporting goods all over. So commercial auto is really important to these commercial businesses. So when you think of it from that standpoint, and you're looking at it from an underwriting perspective, in order to provide comprehensive coverage for these commercial businesses, commercial auto is still a major part of that. So the question is now, how can the underwriters and how can the insurance companies finally find a way to write this successful? And I think that's, what they're really trying to hone in on, using, the greater tools, data analytics and technology, just getting a better understanding from that standpoint. Still, chipping away from a rate adequacy perspective to try and make sure that they're doing their best job there. But I think just as commercial auto risks have changed, and as, from the standpoint of just what we're seeing from a trend perspective, I think they just have to get better at the basic blocking and tackling from an underwriting standpoint, from a risk assessment standpoint, understanding how different risks are changing and whether the commercial auto exposure for that particular risk is one that the insurance companies want to keep within their risk appetite. And then from a claim perspective, also just being able to get out to reach out to claimants quicker, to maybe you do it more quickly. Hopefully, you'll get to them before an attorney is already on the case for that particular claimant. So I think there are a lot of things that can be done better and more effectively. But I think the reason why insurers are still in the commercial auto marketplace is because that coverage, along with the liability, along with the property, along with the workers' comp, is really, it's really a real important part of that overall comprehensive commercial enterprise. And they need, their they need coverage solutions for all of their risk exposures, and commercial auto is one of their main exposures.
Absolutely. The report notes that insurers have reduced their underwriting expense ratio. David, are there other ways that insurers can mitigate these losses?
So, as you mentioned, and I think technology has played a big part in commercial auto insurers and insurers in general being able to better attack things from an underwriting expense perspective. More effective and more efficient platforms has allowed them to really attack the underwriting expense portion of the underwriting income equation. They really, like I said, they really need to focus more on the loss ratio and better attacking that, like I said, from a risk appetite perspective, from the standpoint of understanding their portfolios, how their portfolio might have changed over time, and where the risks are, where the susceptibilities are, and make different decisions from a risk appetite, risk selection standpoint. Understanding, how they want to go about mitigation, offering their loss control services better to their clients, to help their clients from the standpoint of protecting against, protecting their fleets, and also making sure their drivers are have all the defensive driving and courses, or have been availed to all the resources that might help them be more successful. So I think honing in on things from that perspective, the things that can help obviously bring the loss ratio down. And then, like I said, along with the underwriting, I think claim handling, they have to go hand in hand. They have to continue communicating with each other, because a lot of times the claim reps, when they go out to settle the claims, are the ones that understand some of the exposures that maybe the underwriter didn't know when they initially wrote the account. So that communication, keeping that or having that be more effective, I think will also help from the standpoint of what's affecting underwriting income, from helping the loss ratio aspect come down, so that it meets where the improvement we've seen already on the underwriting expense perspective, and that overall can hopefully help ultimately in the long run on underwriting profitability for commercial auto underwriters.
David and Chris, always a pleasure. Wonderful to see you both again. Thank you so much for taking the time to speak with us.
Thank you, Lori.
Our pleasure, Lori.
That was David Blades, Associate Director, and Christopher Graham, Senior Industry Analyst, both in AM Best Industry Research and Analytics area. To view the full report, please visit ambest.com. For AM Best TV, I'm Lori Chortis.